Buddy, for joining us. Don, thanks for inviting me. As Don mentioned, I do a lot of education on reasonable compensation, but most of that is to professional tax and financial advisors. So occasionally I get asked to speak directly to business owners, and that's tonight. So I'm really excited to have a chance to do that. And so we're going to be going through Reasonable Comp 101 for business owners. Don mentioned I'm Paul Hammond. For the first close to 15 years of my career, I was in and around compensation and executive search and compensation. And in the last 15 years, I have been specifically around reasonable compensation for closely held business owners. And most of that has been in and around S Corps, because that's just where it comes up the most. I love reasonable compensation. I find it a fascinating field. I get to talk to business owners and their advisors all the time on reasonable comp, and you learn so much about all these different businesses that are out there, how people are being successful in their business, and then we have a chance to talk to them about how reasonable compensation fits into or applies to whatever situation is going on with that. So when I'm indoors, I am almost all reasonable compensation. I love it. I started RC Reports. We have a super cool company and group of people that work for us. We have a great time doing what we do. We take what we do seriously, but not ourselves. And I think you'll see a little of that come out in the presentation today. But when I'm out of the office, I live in Colorado, I'm outdoors. I head to the high country every chance I get. You'll typically find me either hiking with my chocolate lab or out in a canoe, paddling around a little bit, just enjoying the great outdoors. But enough about me. Let's talk about what you guys want to know today, which is more about the topic of reasonable compensation. I don't know what you all know, so I want to start with the very basics. And for most of the time that we're talking about reasonable compensation, for this presentation today specifically, I have honed it in and around S Corps. We'll talk just briefly here and there about reasonable comp outside of S Corps, but for the overwhelming majority of small and closely held businesses, when we think reasonable compensation, we think S Corps. So we're going to explore why. Why are you an S Corp? Or why might you think of considering becoming an S Corp? And then, of course, what the heck is reasonable compensation? Not as easy a question to answer as a lot of people think, so we'll talk about that. I'm going to spend a little bit of time on how reasonable compensation applies to you all as S Corps or contemplating becoming an S Corp. I'm going to spend a little bit of time on compliance and what the IRS has to say about that, and a little bit of time on valuation and litigation, a little bit weightier topics. But where I really want to spend most of our time today is on planning, because that's where really the benefits of becoming an S Corp and leveraging your reasonable compensation come into play. And then I'll spend a little bit of time on the end talking about how do we actually determine reasonable compensation? How do we come up with a figure that is credible, reliable, and defensible, and why those things are important. So let's get rolling. Let's talk a little bit about why you're an S Corp or why you might want to become an S Corp. Over the years, when I've talked to business owners, I'm always surprised how often I talk to a business owner and I ask them, why are you an S Corp? And they truly don't know. They just know that somebody along the way, whether it was their accountant or a brother-in-law or a bartender, somebody along the line said, become an S Corp, you'll save money. Well, that is the number one reason people either are an S Corp or are looking to become an S Corp, is because somewhere down the line, somebody said, you're going to save money. And where are you going to save that money is on payroll taxes. So that's what we'll be talking about a lot today. But when you're considering becoming an S Corp, there's three reasons typically that you want to consider it. Save, save, and protect. Save on payroll taxes, but as your business matures, as an S Corp, you have a lot more options to put more money away in an S Corp than you do in, let's say, a sole proprietor or an LLC. So we'll talk briefly about that. And then, of course, protect wealth, protection, right? That legal shield that a corporation gives you. So what is reasonable compensation? So I'm going to go through a couple of definitions. I promise not to put you to sleep, but I will give you a very clear and concise definition of reasonable compensation that's easy to remember and think about. But if you ask the IRS, they're going to say reasonable compensation is the value that would ordinarily be paid for like services by like enterprises under like circumstances, right? That certainly clears that question up for most of you, right? No, not super helpful. Valuators do a little bit better job. They tend to define it as the hypothetical replacement cost of an owner or key manager of the business. Okay, that's a little bit more helpful. We also see it posed as a question fairly often. How much compensation would be paid for the same position held by a non-owner in an arm's length employment relationship at a similar company? Kind of wordy, but again, that helps us define it just a little bit more. But here's how I want you guys to think about reasonable compensation. I want you to think about it as replacement cost. Throughout our time together today, I'm going to refer frequently to a business owner named Scott Stone. We're going to take a look at a case study toward the end, and the case study is built on Scott Stone. He's a real business owner. I've known him for decades, and he has a fascinating career and business that he built. But when you're thinking about reasonable compensation in context of replacement cost, this is how I would like you to think about it. As an S Corp owner, if I had to step away from my business for any reason and bring somebody else in to perform all the same duties and responsibilities that I'm performing today, what would I have to pay that individual? That's it. Simple. It's a replacement cost. What it's going to cost to replace myself in the business. Now, there is another definition that's also helpful, and it's the flip side of that coin, and it's fair market value. So as a business owner or as an S Corp owner, if I shut my business down and went to work for a competitor that paid me to do the same duties and responsibilities that I'm currently providing to my S Corp, what would that business pay me? So replacement cost and fair market value are two very simple ways to think about what reasonable compensation is. And if you think about it more as replacement cost, it's also quite handy because RC is a great definition for both reasonable compensation and replacement cost. So if we're putting this in the context of Scott Stone, who we're going to be meeting on and off throughout the presentation today, if Scott steps out of his business and replaces himself, he needs to pay himself for all the duties and responsibilities that he's currently performing, which might include finishing concrete, doing maintenance on his equipment, purchasing supplies, all of those different things. That's how we're going to come up with his replacement cost. So how do you come up with reasonable compensation figure looking at those definitions? Well, it's not that clear, or at least it didn't used to be that clear. It's actually quite clear nowadays. There's a lot more information on it. But for a long time, prior to RC Reports' launch in 2012, began building the company out in 2010, there really wasn't much information out there. And the IRS has put up a ton of information out since 2010 as well. But prior to that, there wasn't a lot of information. So it produced a lot of myths and misinformation on reasonable compensation. Just to give you an idea about how prevalent these myths are and how widely believed they are, let me share with you a polling question we typically ask when we're engaged with tax preparers and financial advisors. Which of the following methods do the IRS recognize for determining reasonable compensation? And so we have three listed here. One is industry rule, and that's where you would set your reasonable comp as a percentage of something like net sales or gross revenue. The 50-50 rule, sometimes referred to as the 60-40 rule, that's where you're going to take in an S Corp total distributions, and you're just going to split it down the middle and pay half out as W-2 wages and half out as distributions. C is the safe harbor rule, and that's where you're simply just going to set reasonable compensation at that Social Security maximum. D is all of the above, E is none of the above. The correct answer here is none of the above. And I'll explain how you actually determine reasonable compensation. When I'm talking to advisors, I go deep into the court cases and additional IRS information. But here's the scary thing. About 3 out of every 4 tax or financial advisors that we've asked believe at least one of the myths. And that's very dangerous because if they believe it, they're likely giving that same advice to their clients. So we spend a tremendous amount of time and resources educating on the topic of reasonable compensation so that advisors understand what is fact and what is myth when it comes to reasonable compensation. Some of the reasons these myths are hanging around, even though we've had really good information for more than a decade, not a shocker to all of you, the internet. Internet is full of misinformation. Sometimes it's from really credible places, and sometimes it's from the dark corners. But you see these myths just propagated all over the place if you start to do searches on the topic. We just saw the 60-40 rule on an ADP blog post. Here's somebody else suggesting that we set compensation anywhere between 30 to 50% of your net income. Not good advice. Some people have very sophisticated metrics or tables to come up with reasonable compensation. Again, not helpful. This might give you some idea of what's advantageous, but it's certainly not considered reasonable compensation, reliable or defendable. The safe harbor rule, setting that Social Security maximum, that can be really dangerous, especially in the early years of a business when you're really trying to save money on those payroll taxes. Your reasonable comp number may be way too high. And then my personal favorite, which is just that wild ass guess, right? You get to decide what a fair wage to pay yourself is and save on Social Security. That is not good advice. And the IRS has very, very specific rules and guidelines on what reasonable compensation should be. So no, you don't get to just decide. So let's talk a little bit about the compliance aspect of reasonable compensation, and then we'll get to planning, which is my favorite part. When we're talking about reasonable compensation in S Corps, most of the time our first exposure to it as a business owner is in compliance. Because as an S Corp, you are required to pay yourself reasonable compensation. But it comes up in other entity types as well. But as I said before, most of the time it comes up in S Corps, but reasonable compensation is a requirement in C Corps. And I don't know if any of you joining us today use any tax planning strategies around hiring family, such as a spouse or children. But if you do, reasonable compensation also applies to them. They need to be paid for the work they're performing, their replacement cost or fair market value. So even though it comes up in all of these different scenarios, most of the time we're talking about S Corps. What's your exposure in the world of reasonable compensation as it relates to compliance with the IRS? Good question. It really depends on who you ask. But I will tell you right now that the IRS is gearing up for this. As most of you are aware, they got a boatload of money in IRA 22 bill, $80 billion, $45.6 billion for enforcement. At one point in time, and I don't know if this is still true, the dollars spent on enforcement by the IRS, for every dollar spent, they got $9 back. So it was a good investment for the IRS. If that still holds true, you're looking at about $400 billion in revenue that the IRS will be able to generate, with 45.6 going to enforcement. 87,000 new agents, maybe, maybe not. That's been batted around. All that being said, this is what I want to bring your attention to, and where I think there's a lot of exposure on reasonable comp. It's technology. Reasonable compensation isn't that all that complicated. And as a business owner, kind of visualize this narrative, right? You go to your mailbox, you get that IRS letter. We all get them from time to time. But when you open this one, it's a correspondence audit. And it's a very specific correspondence audit on reasonable compensation. It says, "Dear business owner, we've looked at your return, and we have looked at your reasonable compensation figure of, I don't know, $36,000 and determined that to be unreasonably low. We've determined that that number should be $76,000, and here is what you owe on that recharacterization. And so now you're in a correspondence audit. Those are a real pain in the butt because you don't really have a good point of contact, but technology can really be used and leveraged on this very particular topic. So in my opinion, that's where I think the most exposure comes from a compliance issue on reasonable comp. Last year, there was a payroll conference, and it's a networking event where the private sector and the public sector get together and they talk about regulatory changes and other changes from the government. Two high-ranking officials from the IRS were there, Paul Mamo and Dan Lauer, and they specifically called out where they're going to be putting their resources. And in the red box, they called out three, and they said, first off, we got those ERC fraud initiatives. I think a lot of us have heard about those. But after that, the low-hanging fruits, S corps and reasonable compensation, and worker classification, which is 1099 versus W-2, or you're paying your employees correctly. So the exposure here is anything to do with a payroll compliance audit. Examiners have been trained to look at reasonable comp and make an adjustment if they think unreasonable comp was paid. So that can happen whether it's an ERC audit or a worker classification audit, or they come in directly looking at reasonable comp. So reasonable comp audits have gone up and down over the years, like a lot of things do. And we had a real spike in them from about 2009, 10 through about 2015, 16, and then they dropped off. But they've been increasing again over the last couple of years. And if the information we're seeing is accurate, we're going to see another big increase in reasonable comp and S corp audits in the coming years. So enough about compliance. Let's talk about some other things around it. And the other one that I want to talk a little bit more about is why, when reasonable compensation applies to your business, in addition to compliance, is valuation and litigation. So most of the time, it's going to come up in a valuation setting, shareholder disputes, or divorce. And shareholder disputes and divorce are just different arenas where evaluation is needed, but that's where you end up in litigation on the topic. So in just a very simplistic way, let me illustrate a little bit about how reasonable comp can affect evaluation. So Scott Stone, who I mentioned earlier, is running a very successful concrete company. And he is paying himself $500,000 a year because he is worth it. Okay, great. Scott wants to exit his business. He needs to have it valued. Or maybe he's going through a divorce and the business needs to be valued. Whatever the situation might be, so he brings an evaluator. And the evaluator is going to do a number of things to come up with a value, but one of the key things they're going to do is what's called normalize the owner's compensation. And what normalization means, what's that hypothetical replacement cost of the owner? So the evaluator determines that Scott's reasonable compensation is $250,000 and not $500,000, and Scott's ego might get hurt, right? But it's not going to be hurt for long when he sees what the result of that adjustment is. Because adjusting Scott's reasonable compensation, or normalizing it down to $250,000, will cause the business to become $250,000 more profitable. If Scott's in a business where the multiplier is 10x times net revenue, that's going to put $2.5 million in Scott's pocket because the evaluator knew what he was doing and normalized Scott's compensation. And so that's the role of reasonable compensation in valuation, and quite frequently in litigation. which litigation, again, generally revolves around some sort of valuation, whether it's a shareholder dispute or a divorce. So just to give you a little bit of idea when it comes up in shareholder disputes, just a short case study. This is a case study of a reasonable comp expert named Stephen Kirkland. There's a handful of experts on reasonable compensation in the country, and Stephen's at the top of that list. And in this case, this was a third generation business. It was an S Corp. And so shares of stock had been either gifted or left to family members. So what started out as a small group of shareholders now has enlarged over 3 generations. So there's a lot of shareholders out there of this closely held business. And a distant family member wanted to cash in their shares. And when they were told what the value of those shares were, they were very upset. And they didn't think they were worth enough. And when they started looking at the financials of the company, they believed that 2 of the shareholders that worked in the company, so picture a company with, let's just say, 30 shareholders, but only 2 of them worked in the company. The 2 that worked in the company were being significantly overpaid. And with that example I just shared with you, that would bring down the value of the business and the value of the shares. So she brought in Stephen. She initiated litigation, and Stephen came in and looked at both shareholders, and he did determine that one of them was being paid a reasonable amount, but the other one was significantly overpaid. And once those adjustments were made, the value of the business went up, and that family member ended up getting a fair settlement when she cashed in her shares. So that's one example of a shareholder dispute. Divorces aren't that much different. This was a divorce case where the business owner had a very high reasonable compensation figure. And because it was unreasonably high, like that first example I shared with you, it pushed the value of his business down to pretty much zero. There was no value there by the time reasonable compensation was paid. So the wife brought in Matt Cassidy, another reasonable comp expert. He does a lot more work in the divorce area. They determined that the husband's reasonable compensation would actually be significantly lower, that hypothetical replacement cost or that normalizing value. That brought the business's value back up, and the wife ended up with a fair settlement. So that's where reasonable compensation comes in most of the time when you're talking about valuation or litigation. But what I really want to spend the majority of our time on today, and this is where we're headed, is planning. Because this is really where you get to take advantage of the opportunities, and why I think a lot of you are here, not only listening to me today, but also part of the Protect Wealth family. So when you're talking about planning and you're talking about S Corps and reasonable compensation, most of the time that planning isn't around entity selection. Or is it time for me to become an S Corp? Should I be an S Corp? After that is retirement. And planning on retirement, reasonable compensation has a lot to do with that. And if you are planning an exit for your company, getting your ducks in a row as it comes to reasonable compensation ahead of time is also quite important. We've already talked about that valuation expert or that valuation aspect, and that's where the exit planning really comes in. But what I want to focus mostly on today is that entity piece and why becoming an S Corp is can be advantageous. So as an S Corp, shareholders can pull money out as either distribution or wages. And so shareholders of an S Corp would generally prefer to pull profits out of their company as distributions rather than wages, because wages are subject to payroll taxes. Distributions are not. However, to prevent S Corp owners from pulling everything out as distributions and nothing out as W-2 salary, the IRS requires S Corps who perform services who provide substantial services to pay reasonable compensation. So this is where the IRS gets involved in requiring reasonable compensation be paid. Otherwise, and you'll see this as we kind of go through a couple of examples, S Corp owners would likely not take much, if anything, out as W-2 wages, but everything as distributions. So that requirement reads as follows. Distributions and other payments by an S Corp to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for services rendered to the company. So that's IRS speak. Let's simplify that a little bit. What this means is if you have an S Corp and you have profits of $100,000 and you want to distribute that to yourself, right? You want to take it out of the S Corp and put it in your pocket. What that IRS requirement is saying is that first and foremost, you need to pay yourself reasonable compensation or W-2 wages, right? So we want to take $100,000 out. We've determined that our replacement cost or reasonable comp is $69,000. We'll use Scott as our example. So Scott will get W-2 wages of $69,000. Then he can take that remaining $31,000 out as a distribution. And that's how that $100,000 goes from Stone Concrete into Scott's personal bank account. So let's talk a little bit about what that advantage actually is for Scott. So let's start out with Scott being a sole proprietor. Maybe he's an LLC, maybe he's not. Regardless, he's not an S Corp yet. So this is Scott early in his career, and he has that $100,000 of net income or profit. And as a sole proprietor, that income is just going to end up on his 1040 because he's going to file a Schedule C. It's already all right there. So if you have at some point in time heard of the self-employment payroll tax penalty, this is what they're referring to. So payroll taxes in this scenario for Scott are going to be 15.3% of that entire $100,000 of profit. Now, I'm breaking it down on the screen here just for illustration, but Stone Concrete doesn't actually pay $7,650, right? Scott pays all of that. If Scott were employed somewhere else and he was making $100,000 a year, he would have $7,650 withheld from his salary over the course of the year, and the company he's working for would match that and pay the other $7,650. This is the self-employment tax penalty that I'm talking about. Scott has to pay both sides. He has to pay the whole thing. So in this scenario, that's $15,300. But Scott wants to become an S Corp and he wants to save some money on payroll taxes, right? Again, this is the reason a lot of us do that. So now Scott is an S Corp. We have determined that Scott's replacement cost or reasonable comp is $69,000. His business has still made $100,000, and we want to take that $100,000 and move it from Stone Concrete into Scott's personal bank account. How do we do that? Well, the IRS says we got to pay reasonable comp first. Easy enough. Scott received W-2 wages of $69,000. He'll take the remainder out as a distribution, so that whole $100,000 still gets to Scott. It just comes out in two different forms. First and foremost, reasonable comp or W-2 wages, and then out as a distribution. And only the W-2 wages are subject to payroll taxes. Distributions are not subject to payroll taxes. So now when we're calculating payroll taxes of 15.3%, right, that's FICA and Medicare, Stone Concrete, which is now a corporation, will pay $5,278, as will Scott. Now, again, this is all Scott's money, right? He's a small business owner. I get it comes from both sides. But because his reasonable compensation is only $69,000, his payroll taxes on this are only just over $10,500, right? Versus the $15,300 he was paying when he was a sole proprietor. This is going to save Scott about $5,000, and this is the overwhelming majority of the reasons why business owners become S corps, because they have an opportunity to save on payroll taxes by paying themselves reasonable compensation, and then everything above reasonable compensation as a distribution that avoids those payroll taxes. In a nutshell, that's the basic advantage. So there is a very strong motivation for business owners to take out distributions and as little salary as possible. But at the end of the day, you need to make sure that your compensation is quote unquote reasonable by IRS guidelines and some of the other information that we get much more deeper into when we work with tax and financial advisors. But the fun part of planning is really that entity planning. So I shared with you just a one-year glimpse at how Scott can save $5,000. But let me show how Scott can put $144,000 in his pocket over the next 10 years by doing proper entity planning. So let's boost Scott's or Stone Concrete's net profits up to $200,000. It's a little bit more realistic for where Scott is in the business. His replacement cost or reasonable compensation is $69,000. Now, when you become an S corp, there's other considerations. So let's take a quick just peek at those. First and foremost, as a sole proprietor, you don't pay unemployment, but as an S corp, you do. So you're going to pay federal and state unemployment. As a sole proprietor, you may not have any payroll. Depends if you have other employees or not. So you may have expenses related to setting up payroll or having a payroll provider. You need to do a corporate tax return for your S corp. That's going to cost some money. So the qualified business income deduction, section 199 cap A, we actually teach a 1-hour course just on reasonable comp and 199 cap A. It's incredibly complex. We do want to take that into consideration, but right now it's slated to sunset in 2025. So that's really a this year and next year problem at this point. That may or may not change. If they decide to keep it around, I hope they greatly simplify it for all of our sakes. And then there could be some other costs in forming the entity. So we do want to make sure we get a clear picture of whether it makes sense or not for Scott to become an S corp. So you're looking at a screenshot from one of our tools inside RC Reports, where we provide some entity planning software. So we've got Scott's net profit in there of $200,000 and his reasonable compensation of $69,000. State and federal unemployment is generally not a very big number, but we do want to consider it. We estimated that at $400. Payroll prep fees, that's optional. Scott could do that on his own, but if he does want to hire somebody to do that, we estimated $1,200. Somebody to do his S corp return, that needs to be paid for as well. We estimated that at $1,500. We did put a QBID adjustment in here. In this case, it's going to push Scott's tax advantage down. This is actually a negative to what it would be if he were a sole proprietor. But what you'll see in the overall analysis is it doesn't really make a big difference. And then, of course, he needs to become an S corp. What's that going to cost? And so we just estimated that at about $1,000. Doing this analysis before you become an S corp is super helpful. If you're already an S corp and you're wondering if you should be, this analysis can also be helpful. In this 10-year projection, we're showing Scott how to put $144,000 in his pocket, not pay it out in payroll taxes. This analysis can also show, and it has sometimes, an S corp owner that they probably shouldn't be an S corp, at least not yet. But I can't emphasize enough how much I would recommend that you do this type of analysis before becoming an S corp. Make sure it makes sense to do that. So that was point one in becoming an S corp, right? Save on payroll taxes. Point two is save on retirement. So I'm not going to spend much time in here because this is a very complicated area. But as a company matures and grows, right, in the early years, right, typically you're just trying to get your business up and running and you want to save every dollar you can. But later in the business's evolution, you want to start putting away for retirement. And as an S Corp, you have additional vehicles you can choose from and different strategies. And so you very, very much want to bring in a financial advisor to talk to you about these things. But you can put more money away for your retirement and get a better tax break doing so. So that's the second place you can typically save money with an S Corp. But keep in mind that the amount you can contribute to these tax plans are based on your reasonable compensation figure. So in the early years, right, most of the time your reasonable compensation is fairly low. As you grow a successful business, a lot of times that amount actually gets pretty high, and you might lose some of the benefits of the payroll tax, but you might gain additional benefits when you start doing your retirement planning. So it's really powerful the way an S Corp can really help from a tax planning standpoint on reasonable compensation. So let's turn our attention to how do you determine reasonable compensation, right? I shared some of the myths with you, but let's talk about how you actually determine reasonable compensation. And so prior to RC reports hitting the market, there really wasn't a lot of information out there. We came out with the cost approach or the many hats approach. We pioneered that. A couple of years after we came to market, the IRS put out some additional information that talked about, in addition to the cost approach, the market approach, and the income approach. I will tell you this: almost all reasonable compensation is determined using the cost of the market, almost never the income. But let's talk about all three. It's good to know why they exist and where they play and how they might be used to determine your reasonable compensation. But when you're looking at reasonable compensation historically, when I got into the business, this is how almost all reasonable compensation was determined, right? It was just a guess, a wild-ass guess, maybe an educated guess, but very little reasonable compensation had anything to do with facts and figures. We came out in 2012, we pioneered the cost approach or the many hats approach, but the IRS a couple of years later put together their own internal job aid. And this was a huge help. It was really the first time all three approaches were put in a document, and an official document. And so the IRS recognizes in this document the cost approach, the market approach, and the income approach. I was told by Don that a lot of folks on our call today are in or involved in real estate. And I've taught reasonable comp for a decade and a half now, a long time. When I talk about the different approaches for determining reasonable compensation, I find it incredibly helpful if I compare them to how a real estate appraiser would value real estate. So that's what I'm going to do here. So let's switch gears a little bit. Let's put on our real estate appraiser hat, and we want to use the cost approach to value real estate. So if we're a real estate appraiser, this might be how we come up with a cost to build or a replacement cost to build a home. We start with a set of blueprints. We do a takeoff of the material and labor that's needed, and we come up with a cost to build that home. Also known as the many hats approach, the cost approach for determining reasonable compensation is very similar. It takes into consideration all the different tasks the business owner provides to the company. It could be such things as administration, accounting, marketing, purchasing, etc. It breaks the time spent by the owner down into the various tasks that are performed, and then wage levels are assigned by the owner's skill level or proficiency. They're all added back together to come up with that hypothetical replacement cost for the owner using comparability data. So the comparability data that's typically used in the cost approach is what's referred to as either cross-industry or all-industry wage data. And comparability data is the gold standard on how we determine reasonable compensation nowadays. Almost all reasonable compensation is determined using comparability data of one type or another. When would you typically use the cost approach? For what we tend to think about when we're talking about closely held businesses, a small or micro-sized business. And this is where the owner's wearing multiple hats, right? They're performing multiple tasks. So let's talk about Scott a little bit. Based on a real business owner, I've known him for decades, fascinating individual, grew just an incredibly successful company over the years. But in his early years, Scott got his start doing residential concrete, doing sidewalks, patios, driveways, that type of thing. And so early in Scott's career, we need to determine his reasonable compensation. He's thinking about becoming an S Corp. So what you're looking at is a paper version of a questionnaire that RC Reports uses. But from that questionnaire, what we've determined is these are the hats that Scott's wearing. He's doing some sales in the evening, some bookkeeping back in the office, purchasing the materials for his job, doing some office management. We call those standard tasks, and we have, I think, somewhere between 38 and 40 of them to choose from. And these are tasks that most business owners perform on an annual or weekly or monthly basis. In addition to that, we want to know what Scott does specific to his business. So Scott told us he finishes concrete and he does maintenance on his equipment. We then want to know how much time he spends on each of those. So we've apportioned out that time, and then what his skill level or proficiency is. If we have that information, it'll take us just a couple of minutes to generate the report. It might take Scott 15 or 20 minutes to fill out the questionnaire. This is what a cost approach reasonable compensation report would look like from RC Reports. This is 2 pages of what's typically a 6 to 7 page report, but the first two pages of the report are really the meat of the report, right? The first page tells you what that reasonable comp figure is, roughly $69,000 for Scott. Second page is exactly how we got there, right? The first page is more for Scott. It gives him the number. In litigation, that second page is the one that's scrutinized. And RC Reports has developed and cultivated a reputation for being an independent, reliable source on reasonable compensation data. We have that reputation with the IRS and we have it in litigation. Our reports are not designed to drive a number up or down. It's designed to come up with what that replacement cost is for Scott. Let's switch gears a little bit and look at the market approach. So early in Scott's career, when he's wearing multiple hats, that cost approach made sense. But let's put our real estate appraiser hat on and let's look at the market approach. So if we're a real estate appraiser, now we're thinking about how we might value property in a tract neighborhood where the neighborhoods are all quite different, but the houses within each neighborhood are all quite similar. So if we're a real estate appraiser, we're going to take our subject property and we're going to go into the same neighborhood that subject property is in. We're going to find other homes that have sold recently. And then we're going to make some adjustments up or down based on square footage or finish or those types of things. And we're going to come up with a value for our subject property. Also known as the industry comparison approach, the market approach for determining reasonable compensation follows that same thought pattern. It determines the owner's compensation by looking at compensation of employees and businesses of similar size and from similar industries. So what that is, that's the same neighborhood, right? The market approach focuses strongly on the owner's business and a specific position being held by the owner. That's typically a management or executive level position, and there's a real practical reason why I'll share with you here in just a second. The approach then compares both the business and the business owner to its peers, and it comes up with a conclusion for what reasonable compensation should be, again, using comparability data. However, in this case, the comparability data we're now using is industry and size specific. So when would you typically use the market approach? When you're thinking about closely held businesses or S corps, these are what we tend to think about as medium-sized businesses, right? So in the early years, it's quite likely that the business owner was wearing multiple hats, but as the business has grown and matured, the owner has moved now more into either predominantly or exclusively a management or executive level position. The practical reason why it's generally used for a management or executive level position is this. Industry specific wage data is incredibly rare and difficult to find in amounts large enough to be credible. However, a couple of areas where they are collected in areas large enough to be credible are in those management and executive level positions. So that's typically why you see the market or industry comparison approach used mostly for management and executive level positions. Scott grew an incredibly successful business over the 20-year time frame since we met him last. He's now moved into commercial concrete, doing large commercial concrete flat work projects. And in this point in Scott's career, he fits very well into the market approach or industry comparison approach. So the parameters that we want to take into consideration to come up with Scott's reasonable compensation figure, right? We want to know what industry he's in. Well, he's a specialty trade contractor, right? Concrete. His position is CEO. The location is in the Chicago, Illinois area. We need to know a little bit about the size of his business. He has 35 full-time employees and adjusted gross profit of $3.5 million. We need to make a couple of judgment calls here as well. We need to compare Scott's business, Stone Concrete, to other concrete companies. We've rated that above average. And we also need to rate Scott as a CEO of his concrete company against other concrete companies. We rated him as high. He has an incredibly good reputation and runs a very well-oiled organization. And then he works a lot of time for his company, like a lot of business owners do, right? We're to be very dedicated to our businesses. In this scenario, at RC Reports, we can generate a market approach report for Scott using those parameters in just a couple of minutes. In this case, for Scott, we're coming up with $275,000. Well, that seems like a pretty high reasonable comp figure. How is that saving Scott money on his payroll taxes? Well, if he's got net profit of $3.5 million, believe me, it's still saving on payroll taxes. But more importantly, Scott now can employ the second reason most people become an S corp, is to save for retirement. So because that reasonable compensation figure is $275,000 and the amount he can push into a retirement plan is based on that number, he can push a significant amount of money into retirement and both save for the future and take advantage of some tax savings by pushing that money into different retirement vehicles. Again, that gets quite a bit complicated, and that's probably an entire presentation on its own as far as different retirement vehicles and strategies for an S corp. Bar none, 99 times out of 100, maybe even 99.9 times out of 100 to determine reasonable compensation for an S corp owner or any small business owner, you're going to use the cost of the market. There is one last approach. I'm just going to go through this quickly, and then we'll get to some questions you all may have. Let's put our real estate appraiser hat back on, and we're now in the commercial real estate sector, right? So as an investor or a commercial real estate investor, what are we interested in? We might be interested in what it costs to build that building, or what it might, or what a similar building might have sold for. What are we really interested in? How much money are we going to make if we invest in that building? What's our return on investment going to be? Also known as the independent investor test, that's the same logic that the income approach is built on, but it differs significantly from the cost in the market in one very, very important way. Does not use comparable wage data at all. It's just built on a very simple formula put together by the IRS. And it determines the owner's reasonable compensation by looking at what a hypothetical investor would be satisfied with as their return on investment when they look at the financial performance of the business in conjunction with the reasonable compensation of the owner. So if you're not using it very often, when does it come into play? It tends to come into play in one of two places. The first is outliers. Outliers are just simply people who have a unique occupation, and because they have a unique occupation, we can't use comparability data. If we can't use comparability data, we can't use the cost or the market approach. Here's where it's almost always used. It's used in litigation or examination, and it's used as a test, thus the independent investors test, to back up a primary conclusion, which is typically a market or cost approach. It can also be used in litigation to test the other side's reasonable compensation figure and maybe discredit it. So if you're using it in Scott's case study, and this is where this case study gets really fascinating, at least in my my opinion. If you've ever heard simple isn't easy, the income approach fits that definition really well. You only need 3 pieces of information to come up with an income approach comp figure, but they're not easy pieces of information to come by. You need the estimated fair market value of the business at the beginning of the year, the increase over the year, and then what that target return or independent investor rate is. If you have those 3 pieces of information, you can feed them into RC reports, or you can just use the simple formula that the IRS publishes. So Scott was a really interesting dude. Not only did he build a really successful concrete company, but he had a fascination with the industry. And so he came up with an additive, a process, and machinery to pour something called seamless concrete. If you've ever been in a big box store and pushed your cart along and every once in a while it clunks across one of those expansion joints or seams in the concrete, came up with a way to pour massive slabs of concrete without a single expansion joint in it. So he's an outlier at this point in time. He's an inventor, and I can tell you there are not wages collected for inventors. So in this scenario, to come up with a reasonable compensation figure for Scott, we fell back on the income approach. You can feed that into RC reports as well if you need that independent investors test or income approach. And in this scenario, we came up with a $550,000 compensation figure for Scott. A little bit about about RC reports and where we came from. If you joined us a few minutes early, you heard a little bit of this already. I started in the industry doing this, and it took me 2 to 3 days easy to come up with a compensation figure that RC reports will now turn out in about 5 minutes. It's because we've built a very reliable database of wages and approaches that will deliver a compensation figure in just a matter of minutes. The other thing is reliability. Our database is recognized as a voice of reason and a very credible place for those who are having a dispute on the subject to both come and try and find common ground. Most of the time, our product is used proactively, however, each year knowing what your reasonable comp is and having that piece of paper, quote unquote, in a file drawer somewhere if the IRS knocks or sends you that correspondence audit letter is where that is. We built RC reports as a tool for advisors, both tax and financial, but we also cater directly to business owners, and we've teamed up with Protect Wealth. If your advisor isn't advising you on reasonable compensation and you want to talk to us about that with us directly, we'd love that. And so we're going to drop a link into either Q&A or chat for you, and you can follow that. If you want to get a reasonable comp report directly from RC Reports, we'd love to help you with that. We've been excited to be invited here to speak with you on the topic. So if you want to take advantage of that, please do so. You can save $50 on a report by joining us today. Typically, that report's $4.99, so you can save $50 on that. You can get that report for $4.99 if you would like to get one for your business and see where your reasonable compensation really should be. Don, I'd love to have you come back on stage and let's talk about maybe some questions we got or some questions that maybe even you have.
There I am, hitting the wrong buttons. I was trying to I was trying to type in and that ended the chat screen. Go back to that one more time.
The
That
promo
link?
screen, that guy right there.
Yes. Um, so let's. Well, you know what? Look, I'm going to let you answer the first. You know what? Here we go. My business is in Texas, Tara is saying, which doesn't recognize S corporations, which, Tara, I think you might be a little off on that one. S corporation election is a federal thing, and so it doesn't matter if you're in Texas or any other state. All states recognize S corporations. When you go to the Secretary of State, instead of filing articles of organization or articles of incorporation, Texas calls it articles of formation. But I'm sure they do. Paul, any thoughts on Tara thinks that Texas doesn't recognize S corps?
As far as I know, they do, but I do know that they sometimes will treat reasonable comp a little differently.
Okay,
Um, for at the state level, but at the federal level, it should be the same. That's where, again, your disclaimer at the beginning, right? At some point in time, you need to really talk to an expert or an advisor on that. So grab your CPA, your EA, or a financial advisor, and get together with them and really help have them help you understand how it relates to you in Texas.
great. Okay, so somebody's asking about the webinar and is it being recorded? It is. If you came in late, it will be sent out to everyone who registered, and it will also be available on our YouTube channel. So you go to YouTube, type in Protect Wealth Academy, and it usually takes about 24 hours to get that recording up and going. So if it's not there at 6 a.m., give us a little bit. It takes a little while to do that, but usually about 24 hours from the time. So if you registered for this conference, which of course you did, or you wouldn't be on, it'll be emailed to you, but it'll also be available on YouTube. Okay, what else? What about a 401k self harbor for single member LLC with S corporation election? Is this a good retirement plan?
If I understand the question correctly, somebody's asking if they paid themselves reasonable compensation of that safe harbor number, which is the Social Security maximum. At least that's what I'm assuming. And what I would say is, yeah, you're putting the maximum dollars into your Social Security account because you're paying the Social Security maximum. But there are other retirement vehicles. And so you can contribute to your 401k up to that Social Security maximum, which I should know that off the top of my head. I think it's is it 152 or 162 right now? $1,000. I'm not sure, but it's a good start. But a financial advisor can be worth their weight in gold when you're trying to really put together a good retirement plan.
Absolutely, and whoever's asking for this, I'm not sure. I don't know if this is the right plan for you, but it's a good plan. It depends on who's running it, and I don't know. Okay, do we pay any tax on distributions? That is, say if it's a $500,000 distribution, yes, you have to pay ordinary income tax. But what Paul's talking about, and then there might be state income taxes. But what he's talking about is self-employment taxes, the 15.3% that you usually pay half and the employer pays half. Comments on that, Paul?
Yeah, but it would be really cool if the answer was no, wouldn't it? But it's not. So yes, you have income. It's found its way to your 1040 via your 1120S as a distribution. The difference is it didn't get there after having 15.3% already taken out of it, in addition to what you're now going to pay as ordinary income. So yes, you do, but overall you pay less taxes.
Yeah, and what you would want everything, because the S corporation can allow you to split. This is reasonable compensation. This is distribution, and you want everything as a distribution. The IRS probably wants everything to be taken out as a salary, so so that you can pay self-employment taxes, and that's really what we're talking about. And this is the value of RC reports, is helping you find that balance. What is reasonable? Because if you count it as if you're counting your reasonable salary way too high, you're paying way too much in tax. If you're counting it way too low, then you're in an audit risk. Is that pretty much what
Yeah,
we're talking about?
you're in an audit risk, and if you keep it that low, let's say, and this is true story, let's say you keep it that low for 30 years because somebody said at some point in time, keep it low and you'll save on payroll taxes, right? And so you're trying to grow your business, but let's say your business didn't end up as successful as you'd hoped. And then one day you check your Social Security retirement account and you realize there's almost nothing there. And that's a horror story, right? So
Right.
those W-2 wages, those contribute to your retirement account. Whether you believe it's going to be there or not when you get there, that's a whole nother conversation. Uh, but there are some unintended consequences of pushing that low and doing it year after year. And so for some business owners who don't, they all have the best intention that they're going to save all that money, but if they don't actually do it and put it away for retirement, and you need Social Security to be there, it's not going to be there, and there's no way to make up for it.
Okay, Alex is asking, what if your company is as a C corp? How would this discussion be different?
Good question. So the reasonable compensation game or strategy over the years was typically this. As an S corp, you'd want to push your reasonable compensation down as reasonably low as you could to save on payroll taxes. C corps would play a different game. They would want to push their reasonable compensation up as high as possible to avoid double taxation, right? That income comes to you as salary, then your distribution comes out once taxed at the corporate level and then once taxed when you receive it as a dividend. And so as a C corp, what we would tend to see is reasonable compensation being challenged as being too high in a C corp and too low in an S corp. Tax Cut and Jobs Act in 2017 made that a very, very gray area. We now see the IRS challenge reasonable compensation as being too high in an S corp because with the QBID, there are scenarios where if you push your compensation higher, you get a better tax outcome. With a C corp, some of those low corporate tax rates, pushing your reasonable compensation low gives you a better tax outcome. So very, very gray now. It's not that as simple way of thinking about it that we used to think about it.
Great. Okay, so let's talk to me about your report for a second. Okay, we put this in the chat screen, so if anybody's interested in having RC reports, do a report and I don't know, just do an analysis of your particular company. Paul, how individualized is this report that you create for them?
It's very individualized. And so what we ask is, what do you do? How do you spend time in your company, right? Are you wearing multiple hats? If you are, then we're going to do a cost approach. If you're not, if you're mostly in management, we're going to do a market approach. Overwhelmingly, we're going to go toward a cost approach. But we give you some cues to say, hey, let's jog your memory. Are you wearing any of these hats for your business? Are you doing some bookkeeping? Are you doing some sales, right? Some of the common things.
Sure.
But then tell us what you're doing specific to your business. Are you a real estate agent? Great, we got you covered. Financial planner, got you covered. Are you a traveling nurse? Got you covered. My favorite is rickshaw driver. Yep, we got you covered. So we have about 7,000 different titles to choose from. And so it's highly unlikely we won't be able to find a compensation figure or a job title that fits you, fits your business.
Now, do you need to see their profit and loss? Do you need to see their balance sheets? What information do you need to be able to draw up a report?
So for reasonable compensation, that is not uh, typically needed for the cost approach. If we head to the market approach, we would need to have a little bit of that information. The cost approach doesn't take that into consideration, right? We're looking for that replacement cost, or that hypothetical replacement cost for the owner. However, for the analysis, yeah, that would be hugely important, right? If you're doing a type of analysis to see if you should become an S corp, yeah, we need to know what that profit is, and we need to know what your
Sure.
reasonable compensation is. Otherwise, we don't have enough information to draw that conclusion or do that 10-year projection.
And how valid is this? I go into an IRS audit. I say, here was my compensation. I took $100,000 in salary, but 300,000 was distribution. And I've got this piece of paper from you guys. How credible is that with the IRS?
So I'm looking for some wood to knock on. I don't have any nearby. To date, 100%. So when you're talking
Cool.
about proactively doing this before you get the question, we're very well recognized within the IRS. You slide that across the desk, and it's been accepted every time. So typically, not typically, always that's been the scenario. Let me just expand on that just a little bit.
Sure.
When it comes to compliance and reasonable compensation, you are guilty until proven innocent. Here's what I mean by that. The IRS specifically calls out that business owners are responsible for their reasonable compensation figure, and for it being reasonable, and for backing that number up. If you don't have that backup, then the tables have now turned. The IRS says, well, you don't have anything to back up your figure. We're going to say it's this. And now you're battling with them, right? But when you do it proactively, you've met what they've asked, right? Hey, look, you asked me to figure this out. I used your own internal job aid and methodologies. Here it is, right? Examiner's going to look at it, check it off their list, and move on. And that's what has happened in every case that this has come up proactively. We're also used reactively, unfortunately, and that's where we become the voice of reason, right? You picked a number out of thin air to save on payroll taxes, and you paid yourself too low at 30,000. Hey, the IRS wants 130,000, right? Because that's pretty close to the Social Security maximum a couple years ago, right? Now we're the voice of reason. Hey guys, let's see if we can get you guys in the room and compromise at something that's reasonable. And so we've had examiners tell business owners and tax preparers, go use RC reports and come back to us so that we can negotiate this out.
Well, what I like about it is you've got a third party analysis, somebody who's not your CPA, who specializes in this. Third party, here you go. It seems like a very reasonable cost. Go over the cost again for you to do a report. Is it thousands of dollars? What does it cost to do a report?
So if you're working with your tax or financial advisor and they're using our software, have that conversation with them. If you want us to run an analysis on you, we charge $499. So $499, that'll give you a reasonable compensation report. It'll be bulletproof with the IRS. If you want some additional help or consulting on that, we can offer that as well. We really prefer you talk to your own CPA or financial advisor about that. But like our presentation today, we know enough about this specific topic to be some help in answering some of the more common questions. Like, what if I can't afford the number that comes out? What if it's more than I made? Well, at that point in time, I'd be asking why you're an S corp, but that's a whole nother conversation.
Okay. Got it. Okay. Alex is asking where the distribution comes from. So Alex, we take the profits of the S corporation and divide it. This much is salary, this much is distribution. But yes, it does come from the profits of the company. Um, Paul, comments?
Yeah, so your company makes, let's say, $100,000. right? But that money is in the company's checking account. You want to get that money from the company's checking account into
Sure.
your personal checking account. How do you do that, right? Well, in an S corp, two ways. First is W-2 wages, and then everything on top of W-2 wages is called distribution. And so that's where that comes from.
Okay, what? Let's say, okay, use your $100,000. I take $100,000 out, and I've taken it out weekly or monthly or whatever. At the end of the year, can I true it up and say this part was salary and this part, or do I need to be doing it regularly, taking payroll, running everything through payroll? How in actuality, how is this actually done?
And it's done in a number of different ways depending on, each individual business. Some businesses are very seasonal. Some businesses you're not quite sure where you're going to end up. Here's my experience is yeah, you can go ahead and draw money throughout the year. We actually do a 1 hour course just on this topic, which is what if my client didn't take reasonable compensation last year? You may have every intention of truing this up at the end of the year. You've taken out 100,000, but if you've taken out 100,000 and we need to reclassify 69,000 of that as wages and then pay the taxes on that, if you don't have the cash in the bank, that's a problem.
Right.
And so you can end up in some prickly situations. Safest is to pay yourself reasonable compensation first, then take a distribution. Second is throughout the year, do both, right? Pay yourself wages each month and then each quarter take a distribution. And that way you get to the end of the year on schedule.
Perfect. Swen is asking, do you do reports for active traders in various markets like futures and forex? And I'm assuming he's talking about not necessarily the profits, but maybe a management company that's managing his active trading. That
Yeah,
would be my.
so yeah, we have traders as an occupation, as a skill set in our database. Yep,
But
absolutely.
if your business is actually owning the futures, the forex, the brokerage accounts, we probably wouldn't put that in an S corporation. I That would not be the way we would, at least our company would suggest you hold that. As a management company, yeah, that'd be good. Me and my wife have an LLC with a profit of 60,000. Is it worth setting up an S corporation with reasonable compensation?
I would need a little bit more information than that, but let's take two different scenarios. Let's say this is a very active business that both you and your wife are working in. If you were to step outside the business and do the same thing for a competitor, what's that competitor going to offer you for that? If your and your wife's salary would be higher than 60,000, then I'd say probably not. But let's say this is a low touch business, right? Let's say you've got some assets on the internet that's generating most of your income, and so you're spending 2-3 hours a week doing some bookkeeping, and your wife is spending 2-3 hours a week doing some programming, right? Those are going to be pretty low reasonable comp figures, and so it very well may make sense for you to convert to an S corp. But you have to do the analysis first. You have to know what your reasonable comp is.
Okay. And students, I've got a C corporation, and then with different owners, I've got 3 different S corporations. My wife has a sole proprietorship, or an LLC taxed as a sole proprietorship. And so some of you are going, well, you get so caught up in what should I be an S or a C or a sole proprietorship or a partnership? And sometimes, depending on the ownership, you could have all four. It just sometimes you just have to get creative, and with the tax code, you can't. If everything is going to come down and collapse to your individual 1040, you can't do that. But I've got these partners over here with the S corp, and this partner here for the C corp, and there's so much that we can do with the tax code and with proper entity structuring. Um, I like the benefits of both, frankly, and so don't get caught up on that. But sometimes we just have to get a little creative. Okay, Jen is asking, are we talking net profits or EBITDA? We're talking net profits, aren't we?
Yeah, yeah, we are.
EBITDA is really for when you're going to sell the business. But no, okay. What about a startup real estate wholesale LLC taxed as an S corp, where in 22 made 100,000 on one assignment, 20 23 40,000 in expenses with zero revenue, reasonable compensation. Any ideas on that one?
I'm not 100% sure what they're asking, but this is a great opportunity to bring up a concept of distributions.
Okay.
So distributions are how you get money out of the company. Did you know you don't have to take them? Right? As the owner of the business, you get to decide if you take a distribution or not. So let's say you have a bad year and you don't want to take any money out of the company or very little money out of the company. That's okay. Your reasonable compensation might be $69,000, but you had a bad year and you only made $23,000, right? The IRS guidelines come in handy at this point in time that the amount of reasonable compensation will never exceed the amount received by the owner. So if you don't take out any distributions, you're not required to pay yourself any reasonable compensation. So
Okay.
if I'm reading that correctly, right, that they had zero revenue, then they're likely not taking anything out of the business. They're not taking anything out of the business. They're not required to pay reasonable comp.
Okay. Looks like he's wholesaling real estate. So he just, yeah, kind of injected himself in. He had $100,000. Looks like he already paid the taxes on it in 22. So now he's just taking $1,000 a month. Um, I would say if you're going to be serious about wholesaling and that you're likely to continue, I would probably spend $400, $500 and get an analysis from these guys and just figure out what's reasonable. Um, I don't know. All right,
Yeah.
Mr. Anonymous, you come here a lot, Mr. We have two active, both S corps, one passive rental real estate. How would you charge? Um, would they need? Well, they would probably need two different reports, wouldn't you?
Yeah. So you're going to need to pay reasonable compensation for each corporation. So think about it from the IRS's point of view. You have a corporation. Corporation pays its employees via W-2, right? You can, if you're an employee and you work for two different companies, you're getting two different W-2s. And so if you have two different S corps and you're working in both, yeah, you need a reasonable comp analysis for both. Now, that being said, right, there's great planning opportunities out there, and they're much more complicated than we're going to have a chance to talk to today. But you can create a holding company and have a single payer and be able to save some on just having a single company pay just a single reasonable compensation fee instead of both companies. There's an article on our website on that. The easiest way to find it is just to go to our blog page and put in multiple, and you'll find a blog post on that. And I haven't really mentioned it today, but we have a tremendous library, just like you do, on reasonable comp. Just about any topic you can think about, put in a couple of keywords, and you'll probably find an article about it.
One of the questions I get a lot is, okay, I'm setting up two or three LLCs. Do I need two or three different tax ID numbers? And the answer is, and I always turn it around as a question. I go, let's say your wife has twins or triplets. Can they all share one social security number? Well, no, you just gave birth to two or three taxed individuals. Welcome to the United States. No, and so I think we're saying the same thing. I've got two S corps. I'm taking reasonable compensation. Do I need a report for each one? And the answer is absolutely. And what a tremendous package. I Paul, let me be honest. I was shocked at your prices on this. I was shocked that it was so incredibly um, low. For less than $500, you do a complete analysis that will stand up with the IRS. Here's what my reasonable compensation should be. I thank you very much for for being reasonable with this.
Uh,
All right, one
that,
last.
yep.
Oh,
And
go
you're
ahead.
more than welcome. It was what we set out to do. Like I said, I was charging $3,000 for these, and spending 2 to 3 days on them. We can do it, and we can do it economically, and we can help just about anybody who needs this. If you need this analysis, then your business is doing well enough that you should have it done.
Good. Thank you. John is saying, please clarify income tax tiers on distributions from an S corp. I assume reasonable wages is being made via W-2. Typical scenario, $56,000 salary with 150,000 in distributions, 100% owner and her spouse, no other employees, residents in California. Um, I think you'd need a lot more information than that to determine whether this is reasonable.
Uh, yeah, I'm not quite sure what the question is. It gets kind of deep. I'm not sure if you're asking if 56 seems reasonable for the distribution amount.
That's how I'm
Um,
for the
sometimes,
salary.
sometimes
Yeah,
people get a little nervous because their salary seems low compared to a distribution. And here's what I would say: just uh, have that credible research and documentation in your folder. Right? Throwing a red flag with the IRS doesn't mean you've done something wrong. Right? It just means that the IRS has a question. You throw a red flag and you don't have any kind of a backup, that's a problem. In your scenario, if the IRS is 56,000 and you took $150,000 distributions, we don't believe you. Well, here it is. We did the analysis. It's 56,000. Oh, all right. There's other low-hanging fruit. We'll see you later.
yeah. And could that be reasonable for what you're doing? Yes. Could it be very much out of line? Yeah, yes, very much out of line. And so, John, not knowing anything about your business, and but I think it'd be worth the what do you say, 495,
499. Yep,
499?
$500.
Cool. Students, highly encourage you to take advantage of this. If this is going to be a blessing in your life, if you're taking a salary out of an S corporation or an LLC, taxes an S corporation, we can't make this any easier for you. We couldn't have given you. I don't think we could have brought a better um, expert on than we brought with Paul tonight. We very much appreciate Paul and his time. It looks like we've run out of time and run out of questions. That never happens, Paul. All at the same time. Students, we very much appreciate you being on. But if this is going to bless your life, please take advantage of that. We put the link in your chat screen. It takes them right to your page. Um, Encourage you to do it. Paul, any closing comments?
Well, one, thank you for having me. Had a blast. I love the questions. Two
Good.
questions that I'll just touch on briefly. If you're not providing services, you don't have to pay reasonable comp. Somebody said they had a kind of a pass-through scenario. Keep that in mind. Just because you're a shareholder doesn't mean you have to pay reasonable comp. You have to be a shareholder employee providing services. So keep that
Good.
in mind. And then a reasonable comp challenge, yeah, it can be expensive. I didn't get into the how much, but keep this in mind. Rule of thumb: for every $10,000 you're off by, it's probably going to cost you about $3,000. Just
Ooh,
rule of thumb.
ooh, wow. Okay. Paul, appreciate your time. It's been a pleasure to get to know you a little bit, and we want this to be a very long-standing relationship between our two companies. Would like to bring you on often whenever there's questions and be able to refer you. Thank you so much for your time, for your expertise. Michaela, thank you for being in the background. We appreciate you as well. And to everyone still on the call, have a very, very pleasant evening. Thank you.
Don, thanks for having me.
You betcha. Good night.